So, hey, good morning. Today I would like to talk about personal financial plans and personal financial decision. In this topic, we will attend some topics such as the first, why is important the financial planning? The second one is the theoretical background of financial planning. How can we make financial plans? So we will discuss what is time value of money, what is the balance sheet, what is the income and expense statement. And then we will use this statement when we preparing our financial plans. And then we will create a small budget and we will discuss what happens if we have a budget deficit and if we have a budget surplus. So the financial planning process, why important in company life or in our personal life? It's important because we have a goals, we have a future goals, and we would like to achieve our personal future goals as well, because we would like to be greater wealth. Is this, I think, is a very simple idea. Then we would like to be secure, we would like to be security finance, and the end is the goals, the future goals, because we would like to achieve our future goals. So this process, this simple model, are three elements. The first is a financial plans, the second is the budget, and the third one is the financial statement. These three things facilitate the financial planning. Why? Because these three elements of financial planning can link the future goals and the actual results. And this financial planning provides direction, control, and feedback to us when we decide about financial things, financial position. So the simple model are three elements. The first element is the financial plans. The financial plans includes evaluate and plan the major outlays, reduce taxes, establish savings and investment programs, includes as well manage credit, secure adequate insurances, implement retirement program, because we have to talk about our retirement years, and some facilitate estate distribution. This is the financial plans. But the financial plans helps to me when we are planning budget, because the budget includes the main income and the main expenses or purchases, and savings and monthly or yearly basis. But how can we create budget? Easy way. Before we create budget, we have to review and we have to control our actual financial results. So we have to measure our financial results or financial performance. How? We have some financial statement, and we will highlight two important financial statements, the balance sheet, and the second one is an income and expenditure statement. So this simple model, so financial plans, budget, and financial statements, is very easy to adaptate to company or firm or small business life. And we can use this small concept or small model in our personal financial decisions. But there are lots of factors that influences our financial decision or financial behaviors, such as dual income families, The second one is an employee benefit choice. And the third one is an major life changes. For example, what is major life changes? The major life changes, for example, we got a first job. It's very hard and influences our financial position in the present and in the future as well. Or we got a marriage, or we get a very good marriage, or not, depends on. We have children in the future, so bigger family, 1 child, 2 children, 3 children, so big family is major life changes. It's a very sad thing, that of family number, so can influence influence our life. And the second is a divorce. It's not the bad news. Yeah, this is other factor. Maybe change in health, and we have to give up the work, and we lost our work, for example. And the last one is the macroeconomic or economics performance. Maybe the economy, Australian or another economies, goes down, and the result is high inflation, recession, high employment, high unemployment will change our life, and will change our financial decision in the future. So, but we are lucky because there are many financial planners, organizations, institutions, banks who can help us to plan our financial decisions and financial plans. For example, commissionized salespeople who work in financial institutions, banks, foundation, investment foundation, for example. Then we can help and ask help fee-only financial planners who works with individual client, individual persons, and we can combine the first 2 types of financial planners, and can be financial planners who charge both fees and commission and offer some services. And nowadays is the most significant and important type of the financial planners is the computerized financial plannings, who prepares our financial plans in Excel or other financial programs, and they work in a financial institution. But when we choose a financial planner, we have to be careful, because the financial industry is unregulated, very large and unregulated industry. But I have some tips when you will choose a financial planner in the future. So you can check my tips, for example. So we have to know what you want. This is normal. We have to talk others. We have to and we need to get some references from other people, family members, for example, friends, etc. We have to go interview not just one planner, several planners, and we have to choose then the right person, the most appropriate person. And we have to check the planner's background, maybe get in the writing, not just in face-to-face and oral communication. Write, please, what's your plan? And receive regular statement, and if it's necessary, we reassess the relationship regularly. When we are not satisfied, we can change financial planner or financial institution. So now we started to discuss the theoretical background of financial planning. The first thing is the time value of money. Why is important the time value of money? The time value of money is important because $1 in the present today is worth more than $1 received than in the future, because this money can be invested and earn interest. So this concept, the time value of money, is connection between present value and future value of money, because present value and future value of money is not equal. Yeah? Because $1 today is worth more than $1 tomorrow, not just in the next year. How can you calculate time value of money? So we have a lot of ways: formulas, tables, calculators, Excel, or some internet calculators. In this topic, we will keep it very easy, this thing, and we use easy two formulas when we calculate present value and future value of money. So, what is present value and future value of money? Let's start with the future value of the money. The future value of the money is a very simple formula. So we are in the present, yeah? We have $1 in the present. This is a PVO. And as I mentioned, when we invested this money in the future, we can earn interest income. So we got 1 plus R interest income, and T means the time period in the future time period. So FVT is in the future value of money. Yeah? PV is the present value, is the now, is today. And R is the interest rate, the return of money. And T is the period, time period, maybe 1 year, 2 years, 1 month, 2 months, or 1, 2 days. You know. And we have a very simple example, and this is your turn. Maybe you have to use this very easy formula. We have now $5,000, and we know the interest rate is 10%, and we invested this $5,000 for 6 years. And I have to calculate exactly what is the future value of $5,000. How can you calculate? We know PVO, we know R, and we know the T, the time period. Yeah? So try to calculate now the future value of $5,000. Okay, so I will give you 1 minute, and then I will show the solution and the concept. Alright? So you just have to use this very easy formula. So we know the present value, this one. We know interest rate, it's 10%. Be careful because it's percentage. And we know the T, the time period, is 6 years. So in this very easy formula, tell us how we calculate future value of money. Then we invested this money for 6 years. Yeah? So, I think it was really easy to calculate. So, let's check. So, this is 500 times 1 plus 0.1, because 10% means 0.1. So, we use this formula of percentage. So 10 is divided by 100 is 0.1, yeah, as well, to the power of 6, because the time period was 6 years. So if we have today $500 and invested it for 6 years, and the interest rate is 10%, the value of money is $8,858. So it's a very simple concept, because we have whole year, 6 years, we have annual interest rate. It's not complicated exercise and task, yeah? But we can change this question. We can calculate present value of money if we are planning maybe that in the future, maybe 5 years, after 5 years, we have $6,000. or $10,000, and the interest rate is 10%, the time is 6 years, and how much we worth this money today in the present. So this is the inverse form, or this is an opposite of present future value. This is a present value. Just I divided by the future value with the interest factor 1 plus interest to the power on t. So just I make the opposite thing. But the notions are very and totally same. So the question now, you wish to accumulate a retirement fund of $300,000 in 25 years. If you can invest at 7%, what is the deposit that you invest today if you would like to achieve this goal in the future? So we have money in the future. I know the time, 25 years is the time period, and we know the interest rate is 7%. So now we have to make the opposite process. We have to make, and we have to calculate the present value of this amount, $300,000, because we have $300,000 in the future in 25 years in the future. So it's an inverse or changing procedure. Yeah? I will give you a time and you can calculate the present value of this amount. So, just we have to put the numbers and the figures in the formula. Yeah? So, we have $300,000, interest rate is 7%, the time is 25, just put in the formula, and we can use
5,100, 2,074, 700.
Yep. Maybe it's a big mistake, sorry.
That's alright.
Okay, this is my calculation, I think this is correct. But you understand the concept. So what's the difference between future and present value? Okay, sure. So it was the first element of financial planning. The second tool is the balance sheet. What is the balance sheet? The balance sheet is a simple thing. The balance sheet is a statement of your financial position at the one point in time. So the balance sheet includes assets, liabilities, and the net worth. What is the net worth? Net worth is total asset less total liabilities. This is a personal or individual wealth at one point in time. So the assets are in fair market value in the balance sheet. Liabilities means loans and debts. And the net worth is our equity portion of personal wealth. This is the simple concept of balance sheet. So total asset less total liabilities equal to net worth or personal wealth. But the main question is, what is the asset, what is the liabilities? It's not too difficult because the asset is what you own. Maybe checking account, savings account, computer, car, investments, furniture, things what you own. And the opposite, what you owe, is the liabilities. For example, a car loan. For example, credit card balances, or education loans, or unpaid monthly bills. And we have asset, liabilities. The difference is the net worth. But the net worth can be positive and can be negative number. When it's positive, we are solvent, so we have enough money to cover our financial obligations. And can be negative number. If the net worth is negative, we are insolvent, so we don't have enough money or we don't have enough assets to cover our financial obligations. This is the main problem, the solvency. But we can measure the solvency, and we will check in a simple formula, and we can measure we are solvent or insolvent position at one point in time. The third one is the income and expenses statement. The income and expenses statement includes our income and expense under given time period, 1 month or 1 week or 1 year. It's very easy concept, easier than the balance sheet, because we have to collect incomes, we have to collect expenses, and difference between income and expenses is the cash surplus. When total income is higher than total expenses, or in another case, when this difference is negative, so the total expenses exceeds total income, we have a cash deficit. The main problem is the red letters, the cash deficit. How can we avoid the cash deficit? Yeah, it's the interesting question. But what is income and what is expense or purchases? Income is very easy. We got money, we receive money. For example, we have wages and salaries, is the first thing. Or we got bonuses. Or we have interest, and we got interest income. Or got child support, tax refunds, or maybe gifts. This can be income. The other side is expenses or purchases. Expenses and purchases can be fixed and can be variable. Fixed if you have to pay regularly, month to month, year to year, week to week. For example, rent or mortgage. Yeah? Mortgage is long-term loan for flat or house. So rent or mortgage payment, TV, insurance, we have to pay regularly, month to month, week to week. And can be variable, is not regularly. Sometimes we have to go to the cleaner and have to pay the dry cleaning invoice. Or we are going to the restaurant and we have to pay the bill in the restaurant. Or recreation, because we are pretty tired and we have to go to spa or other entertainment facilities. So this is a variable expenses. So this income and expense statement includes our total income and our total expenses, and the balance can be positive, negative, surplus or deficit as well. So we have tools: time value of money, yeah, balance sheet, income and expenses statement. So we can combine these three things, and we can use these three things when we are planning our financial position. So how? The main requirements: maintain good record-keeping system. So we have to know data, or expenses, or incomes, or assets, or liabilities. We need prepare financial statements periodically, not just hectic, regularly, periodically, week to week, month to month. And we have to track financial progress. So this is the three requirements when we would like to use the previous three theoretical thing of financial planning. The tool is the ratio analysis. So we calculate ratios from these three elements of financial planning. Because why? Because these ratios can measure our financial position or financial situation. These ratios can tell me we are solvent or insolvent, or we have deficit or sufficit or surplus. So this ratio can measure our financial situation at one time period. So from the balance sheet, we can calculate the solvency ratio and the liquidity ratio. The solvency ratio, so ratio is a fraction, so all ratios will be a fraction. So the solvency ratio will measure the solvency risk at a given time. So the solvency ratio compares total net worth and total assets. And what is the best result? What do you think? Higher or lowest solvency ratio is the best for us? Higher. Yes, exactly. The higher, because if solvency ratio is higher, if the total net worth is higher than total assets. So we are solvent because the net worth is a positive number. So we can cover all total assets at this time our net worth. So the large number means the best solvency situation. It's important. The highest number is the best solvency situation. The second ratio from the balance sheet, I mentioned the liquidity ratio. The liquidity ratio measures the liquidity risk. What is liquidity? How can I pay the short-term obligations, short-term loans from liquid short-terms within 1 year's assets? This ratio is the liquid assets is divided by total current debts. So current means short-run, within 1 year assets. And liquid assets, short-run assets, within 1 year assets. What do you think? Higher or the lowest number is the best? I think you? If the liquid asset is higher than total current debt, because if the liquid asset is higher than total current debt, we can finance our short-term debt from liquid assets, because we can sell liquid assets and we can finance this or short-term financial difficulties. So the higher number is the best liquidity. Some writer and some books said the liquidity ratio is best if it's higher than 1. Higher than 1 or higher than 100%, because in this case we can finance our short-term debt from the liquid assets. How? We can sell our liquid assets very easily. We have two more ratios from the income and expense statement. The first is, I think, is really easy. Maybe you have heard. Is a savings ratio. The savings ratio shows our savings position at a given time period. So savings ratio is a percentage. How many percentage money can be saved from after-tax income? So this is a simple ratio. Cash surplus is a positive difference between income and expenses divided by income after taxes. So it's a net income. So tax means in this case personal tax. And it's neutral and is not too serious.